The savvy investor has many tools on their tool belt to make wise investment decisions. These tools can be used across various types of investment vehicles. One of these vehicles is the stock market. But how does a savvy investor know when to buy into a stock when it represents a good value to buy in? This is where intrinsic value comes into play. Knowing what price to buy into an asset and having patience is key, along with the right vehicle and strategies to maximize returns on their investment and create massive wealth. In this video, I'll discuss how you can calculate the intrinsic value of a stock, giving you key insight on when to buy and sell a stock to create maximum return on your investments. Get ready. You are now entering the Academy. Value investors are concerned with determining what's called the intrinsic value of the companies they wish to invest in. This intrinsic value nearly always differs from the actual trading price of the stock, presenting investors to buy for less than the company is really worth. Value investors know when to invest in the stock of companies which are going to grow for the foreseeable future. With a healthy growth rate, the price of the stock will be some amount higher than what it is today. As a starting point, the best way to calculate the intrinsic value of the stock is to try to predict what the future stock price will be, typically 5 to 10 years down the road. Once this future value is estimated, the next step is to work backwards to determine how much the stock is worth today. This value is what's called the intrinsic value. The key here is that if the stock is purchased for the intrinsic value or for a price less than the intrinsic value, then there is a certain level of guarantee to achieve a minimum rate of return used to calculate this intrinsic value. To add an extra level of security, a margin of safety is usually applied to the intrinsic value in an attempt to further guarantee this rate of return is achieved with high predictability and assurance. The method that will be used to calculate the intrinsic value is what is called the EPS Growth Capitalisation method. The first step is to calculate the future stock price. For now, we can use a time frame of 5 years to reduce variability. The further out we go in a time frame to try and predict a future value, say like 20 years or more, the more probable that the estimates will be off, and therefore the higher the variability in the calculations. To calculate the future stock price, the EPS or earnings per share ratio is used to calculate this value. First, we will use today's EPS of the stock as a starting point and apply a compounding growth rate of 5 years to calculate the future EPS in 5 years. The equation is F equals P times 1 plus R to the nth power, where F is the future EPS, P is the current EPS, and R is the compound growth rate, and N is the number of years. So let's take Apple, ticker symbol APPL for example, and calculate future EPS in 5 years. First of all, let's calculate P. In order to calculate the current EPS, which varies from quarter to quarter, take the trailing 12 months EPS reported, which can be found online. For Apple, its EPS TTM, or trailing 12 months, is equal to 11.85. To calculate R, the growth rate, we find the EPS 5 years ago, which is the TTM EPS 5 years ago, and then calculate the growth rate in the previous 5 years till now. When we look for this information online and we do the calculations, we get a growth rate of approximately 25%, which is typical for a growth stock or company. Our N is 5 years, so now we have all the variables defined and we can go ahead and make our calculation. We can now calculate the future EPS, which is 11.85 times 1 plus 0.25 to the 5th power, and that future EPS value comes out to $36.20 for Apple. To calculate the future stock price, we simply take the future EPS, which we just calculated, and multiply it by the future price per earnings ratio, where P is the future stock price, EPS is the future earnings per share, and PE is the future price per earnings ratio. For the PE ratio, during the last 10 years, Apple has had a minimum PE ratio of 9.32 and a maximum of 25.33. Assuming Apple keeps the same PE ratio of 25 into the future, we can now calculate our future price as $36.20, which is the future EPS, multiplied by 25, which is the future PE ratio, and we get a future stock price of $904 in 5 years for Apple. To calculate the intrinsic value, we now have the following formula. P equals F divided by 1 plus R to the nth power, where P is the current intrinsic value, F is the future stock price, R is the minimum rate of return we are willing to have for this investment, and N is the number of years. Now we can calculate the intrinsic value of Apple as it stands now based on a minimal rate of return of say 15%. So now we have P equals $904 divided by 1 plus 0.15 to the 5th power, which turns out to be $449.50. The current intrinsic value per share of Apple is $449.50 based on our estimates and future projections into 5 years. Typically, you want to add a margin of safety in order to further guarantee value purchase price to the position. A margin of safety of 50% will add a further guarantee that the requested rate of return, which is 15% per year, will be hit in 5 years. So 50% of $449.50, we get $224.72. This would be the ideal price to buy into Apple to maximize your chances of achieving a 15% ROI within 5 years. As the current price of Apple sits at $295.75, a pullback to our intrinsic value would be ideal to achieve maximum ROI potential. By employing the strategy mentioned in this video, which is how to calculate the intrinsic value of a stock, you can execute on low-risk opportunities to buy into a stock and maximize your returns along the way. Through careful planning and diligent investment of capital, as well as reinvestment of any dividends that get paid along the way, one can create a capital gains and dividend income stream that can provide substantial income, eventually covering everyday expenditures and beyond. The M1 Finance stock trading app provides a great vehicle which allows for commission-free buying and selling of stocks, thus providing a great way to create and grow an income portfolio using the intrinsic value strategy mentioned in this video. Be sure to check out the links in the description to get started on creating your very own passive income producing asset and start your path toward financial independence. Thank you for watching this video. If you enjoyed this video, don't forget to smash the like button. It will really help the channel grow and the YouTube algorithm show this video to the masses for free financial independence education. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.